So let's kick the show off talking about taxes. In 2017, Congress changed the tax laws with the so-called Trump tax cuts, and many of us don't itemize anymore. When those tax laws expire in 2026 at the end, December 31st of 2025, that might change for you. You might go back to itemizing. Here's wealth advisor Judy Brown on Yahoo Finance.
The one that's going to really affect most people, are all the tax brackets shifting. Like the top tax rate is going to go in half. So people that weren't itemizing might be now. So that's when we're going to really see a lot of tax planning that will be very valuable.
Especially when it comes to retirement. So how do you guys help people plan for taxes when it comes to retirement?
It's absolutely something that's important. And I think, even this example with the tax law set to expire in 2026, it's a lot that could change, after the election. I know that they have talked on both sides about their opinion with tax law changes. And, I guess the opinion when leading up to the election and post-election are two different things. But, when we look at it, we put together what's called the Retirement Team Action Plan. And the team stands for taxes, estate planning, asset protection, and money management. And it's always important, I think, to talk with your accountant or CPA when you're looking at making tax advice and making decisions on changes to your investments in your portfolio. We service and helping them in that holistic approach and taking taxes into consideration, running the numbers past a CPA or accountant and making sure that everybody's on the same page. I think regardless of who wins the election, we have a massive tax problem and debt problem that we're going to have to deal with in the future. And it's fair to say that if history is a guideline, it would say that tax rates could be a lot higher for everybody. But in retirement time, taxes are different in retirement than, when it's been in your working years. And a couple of things that jump out to me is, number one is the impact on healthcare costs pre-65, and then also Medicare cost premiums post-65. Give you two perfect examples. I'm working with this couple, John and Mary. John's going to be turning 65 and retiring at the end of this year. Mary is 62, so she's got a couple of years until she gets to Medicare age. They have an income of $1,000. Where to take money out of their accounts and how to, fund their income goals, things like when to turn on Social Security. And all of those things are going to have a big impact, more specifically in this case, in Mary's situation, because the income that you have, that's your taxable income levels from 62 to 65, if you're on the Affordable Health Care Act, can have a big impact on how much you pay for health care based upon what you report in taxes. And if you report the wrong number when you go to file your taxes, they could ask for that credit back. Ultimately getting in a situation where thousands and thousands or tens of thousands of dollars back if you got a healthcare premium and your income was too high. For people that are over 65, one of the questions that oftentimes comes up is things like paying off a mortgage. And, I would say conceptually, I agree with that concept. I think being debt-free in retirement is a good idea. But again, the income that you take out of retirement accounts is going to be reportable for what your Medicare premiums are. So if you're not careful what you do with your income levels, your Medicare premium can go up and double in price as well. The second thing that taxes are different is taxes on Social Security benefits. The question is, take money now or take money later. In John and Mary's situation, their original plan was they were going to start taking Social Security right away at retirement time when John retired at the end of this year, again being 65, Mary's 62. Part of the problem with doing that is by taking Social Security benefits early, it's countable for that impact on healthcare costs, but two, they're then taking a lifetime reduction of benefits. And by running a Social Security optimization report, at least getting John to his full retirement age can be something that's beneficial. In fact, he could delay taking Social Security to age 70. I'm not sure if they want to do that or if that's their best approach, but taking it later means more income. The other advantage of that is the income that you get from Social Security currently is only up to 85% countable. a traditional retirement account like an IRA or 401k, it is usually 100% taxable. So again, Social Security can be more tax efficient in the long run than just standard withdrawals from a retirement account. So then you're looking at, which investment account to pull from. Do you take from the taxable account, tax deferred, tax free? And the answer for everybody, again, using to keep their healthcare costs affordable, they want to, withdraw a certain amount of money from their tax deferred accounts. They don't want their income to go too low because then they fall into what's called Medicaid type status. There some of the premium tax credits for healthcare costs to keep it low. So they might, want to use some of the money that they have from their taxable account. And then the last category is, looking at, when do you pull money from tax-free accounts? So looking at those Roth IRAs or looking at when to take money from those accounts would be the other situation. And it's kind of one of those moving parts on figuring out which accounts to pull from. And the impact of what you do and how you pull that out can have an impact on, again, taxation of Social Security. It's going to have an impact on your health insurance cost. It can have, an impact on how much money you leave for a legacy. Which assets are better to leave in a legacy and which assets do you pull from, different. The number 4 is talking about the issue of possible tax rates in the future. And we're in a situation where we're spending money faster than we've ever spent. We've accumulated this national debt, and we have this massive amount of unfunded liabilities with things like Social Security, Medicare. And at the end of the day, issues that they keep kicking the can down. At some point, somebody's going to have to pay for this. My opinion is if you look at your retirement account, it's usually your biggest or your second biggest asset that you own. And tax deferred means that you could end up paying higher taxes in the future. So when you're looking at taxes today, things like Roth conversions and considering maybe where you're at strategically or tactically in your, tax brackets can make sense to try to hedge against the possibility of higher taxes. I think society has taught an overwhelming majority of people that, hey, save and invest for the future because your tax rates will be lower. And that may not very well be true, especially, for folks who did save. Number 5 is the issue of required minimum distributions. Again, dependent upon what age you're born, but in general, people that are age 73 or higher need to take out required minimum distributions. And even though they may not need that money, that's going to be taxable income if they have that money come out to them. There again, if they're philanthropic, maybe they donate to their church or they have a charitable organization that's important to them, there could be some strategies to help minimize taxes based upon what they do with those required minimum distributions. And even thinking about it from a legacy standpoint, if charity is important to somebody, which assets you leave to charity versus which assets you leave to kids will have an impact on taxes in retirement. And then the 6th issue is capital gains taxes. So in John and Mary's situation, they have about $75,000 left on their mortgage. And looking at their overall monthly payment, it was about $2,000 a month. And they asked the question of, should we pay off our mortgage between some of our savings and outside investments, and does that make sense? And they're kind of weighing the fact that their outside investments have been performing well. The market's done good. And understanding to know that if you took those non-retirement accounts, you sold those assets and you had a gain, that gain would be a capital gain tax that they'd have on that. So navigating how do I pay and plan for taxes in retirement, overwhelming majority of the time, people will go to their CPA, go to the accountant, or log into TurboTax, and they'll do what I say is recording history, right? They'll put in all of their 1099s, they'll put in their tax forms, and it'll spit out the results. And, whether they owe money or whether they get a refund oftentimes depends upon how they feel, right? I feel good because I got a refund. Well, if you had some strategies in place and you could significantly reduce your tax liability not only this year but also in the future, that's really what proactive tax planning looks like when you're looking at these type of strategies in retirement time. And developing a plan, and again, the retirement team action plan, it means that we can create a team action plan. And in that team action plan, we can go through the tax savers checklist, look at 25 different items. We can create a tax roadmap for you that shows you what things look like today versus sometime in the future. Again, luckily in John and Mary's situation, he came in to see us, and as the date of this recording here in September, he has some time before he retires at the end of this year. And there may be strategies, there most likely strategies that we're going to implement before the end of the year to help with his tax planning, specifically in Mary's situation to keep their health insurance cost affordable. But he has to kind of make those moves this year, because if he makes those moves next year, it'll show up on his 2025 impacts his health insurance costs. So, folks, taxes are a confusing topic. If you're frustrated about taxes, or if you're just not sure, are there things that you could do to lower your taxes? We'd love to talk to you. We'd love to make some referrals if you don't have a good CPA or accountant, or more importantly, work with your CPA or accountant to develop a plan that's best for you in creating that retirement team action plan. So if you have more than $250,000 of retirement assets, give us a call. We'd be happy to put that together for you and help you plan for taxes and retirement.
It's a major difference between looking in the rearview mirror and how much you owe for the previous year, and then looking through the windshield and seeing how much, what is coming down the line and how to mitigate that. There's a difference between knowing that taxes are different in retirement, knowing how they could potentially be different in retirement, and how they will be different for you, and how to go about planning for that. A great start, this retirement team action plan, including that tax roadmap. If you've got $250,000 or more in investable assets, give a call. Complimentary retirement team action plan, 419-794-3030, or you can visit the website as well, and that is at arhq.com.